Hello from Otet Markets. This is Ahura. We'll be with you to have a short review of personal income and spending data from United States and market reactions. As always, first let's check what we had as a data, and then we can see how the market reacted to this data and how they have to react further. Core PC price index on the monthly scale increased by 0.2%, much more than 0.1% in November. On the annual scale, core PC price index increased by 2.8%, in line with expectations and at the same pace of the previous month. But the headline PC price index on the monthly scale increased by 0.3%. Yes, it was in line with the market expectations, but 3 times more than 0.1% increase in November. And on the annual scale, PC price index increased by 2.6%. Yes, again, in line with the market expectations, but higher than 2.4% in November. But adding to these, increasing the numbers, what's more important here in the published data, in the data which we published so far, is the personal spending. The personal spending increased by 0.7% just in December. And also, the November number increased to 0.6% in the revised data, up from 0.4% in the initial numbers. That means that the spending is higher. That means that with the hot labor market that right now we have, with the more wages that right now we have, the people are ready to spend more money, and they are already spending more money. And when they are spending, when there is more spending, it means that there is more demand, and more demand always increases inflation. If we look at the FedWatch tools right after these data, publish these data, right now with these data, there is a more than 82% chance for holding the current rate in a March meeting as well. So, which means with the higher demands, there is a less chance right now, or we can say better not to say the less chance. We can say that the Federal Reserve will have much higher much harder works, or we have much more challenges to control the inflation and bring it down this current level of inflation. That means that for now, with these numbers, we have to expect the higher level of the rates, higher rates for longer to be able to control these inflation. Let's see the market's reaction to these numbers. So these data confirms as a revision with the higher spending, and when we have a higher demand in the market, we can expect that Federal Reserve to hold the inflation higher for longer. The policy of wait and see can change to higher for longer again. As a market reaction, we can say that with the higher inflation, with the higher rates, we can expect the higher yields for U.S. bonds. And when there is a bonds higher, the U.S. dollar always getting stronger. I'm sorry. So always the higher rates is a positive data for the US dollar value. So higher rates for longer means a positive data for the US dollar value, but it can always be a negative for stock markets. That's why we can expect this a little bit more pressure on the stock market. So higher rates for longer, while it's a positive for the US dollar, is negative for the stock market. At the same time, if you look at the gold chart, you can see that the gold price also increasing. So that means even thought that the US dollar is getting stronger, which usually should be negative for gold price as it's the XAU US dollar. But it's positive. These numbers are positive for gold price as well. Why? Because these numbers means that we can expect more pressure on the stock price, and a higher pressure on more pressure on the stock prices means we can expect that the money to get out of the stocks, and they're looking for this cash should look for safe havens, and these safe havens. One of these most important safe havens is the gold. So that number, or these inflation numbers, are positive for oil, for gold price. On the other hand, if you look at the oil chart and the energy chart, since the higher rates are negative usually for the companies because they can get less cash because of the higher when you have the higher rates for loans. So you can have a less cash and you can have a less lower cash in the market, less investments, which is the negative for this usually for the stock markets and for usually for the company's growth. So the company negative for the higher rates are the negative for the company growth, which it means the negative for the stock markets, negative for the company growth, which it means that the lower demand for the energy, and it's a negative for the oil price as well. So that number, while it's increased the price for the US dollar, at the same time, it can increase the demand for the gold, put the pressure on the oil market and stock prices. As for the cryptocurrency can have almost the same reaction of the same reaction, same as the stock markets, and that number can be negative for the cryptocurrency, especially for the Bitcoin. So that number we can say, I haven't thought if we cannot say that it's a negative for the Bitcoin price, but it's not. It cannot be the positive as well. So negative for stock markets, not good for the cryptocurrencies, negative for the oil prices. It can increase the gold demand and also the demand for the US dollar index, as both gold and US dollar index, they are both safe haven. That was the US personal income and spending numbers and market reaction. If you had any other question, don't forget to write in the comment section. I'll try to get back to you as soon as possible. Have a good time. Bye.